Hello everyone. My name is Longley. Welcome back to my channel. Today, I am so excited to introduce to you Gwyneth Boy. She is an extremely experienced CPA in the field, has been doing tax for almost more than 20 years. And today, I'm lucky to have her with me today and to answer all the questions about tax for homeowners and investors. So please welcome her to the show. Hi, Gwyneth. How are you?
Hi, Long. I'm fine. I'm fine, and thank you for having me here. And hello to your audience.
Hi, thank you so much. And we are going to do this mainly in English because there are more audience. But we are also taking Vietnamese question too. If anyone who doesn't speak English, feel free to comment in the comment section, and then I will reiterate the question to Gwyneth. I do have a couple of questions prepared for you, G. The first question is about tax deductions. We're in the tax filing period right now, and a lot of people owning a home as a primary home. And the question that I always hear from my seller client, is that what are some tax deductions that as a homeowner they can have?
Okay. As a homeowner, if they have mortgage, then they can deduct the interest that they have, and if they pay property tax, sometimes they will be able to deduct that property tax they pay. Um, there are some cap limit with the property tax they pay because of the 10,000 tax and local state tax and local tax limit. But if they are under that and then they using itemized deduction, they'll be able to deduct both property tax and interest that they pay.
Okay, and the limit you talk about are different depend on state, right?
Um, no, the limit I'm talking about is the $10,000 property state tax and local tax limit. That the federal new law that enact on 2018. It is applied across the board, all the state.
So what I'm hearing is that mortgage interest is one, property tax is number two. Those are the number two thing, most important tax deductions that as a homeowner you can claim during tax season.
That is correct. Yes.
Right. All right. So the next question is, how do we maximize those tax deductions for homeowners? So if I am owning a home right now, is there any trick and tips that we can like maximize those tax deductions?
Um. No, actually, you can only take the deduction when you are using itemized deduction. Um. Right. This year, the itemized deduction. You only using that deduction when if you single your deduction of interest and local tax and state tax is more than 12,200. If it under 12,000, 12,400. If under that, then you will use the standard deduction. And if you are a couple, that limit is I believe it's 24,800, and it changes every year.
Gotcha. And you said 12,000 for single.
12,400 for a single person. Yeah.
Gotcha. And 24,000 for a couple following together.
Yeah, 24,800.
So it's really benefit for the homeowner if the itemized deduction is more than that standard deduction, correct?
Yeah, they have to choose one, either itemized or standard. And normally, when they come to a tax office, when their deduction, when the itemized deduction is gross over standard deduction, we will advise them to take that. So when you come to a tax office, it is advised to bring all the paperwork that your mortgage company sent to you at the end of the year, the tax that you pay. if you cross over to itemized, then we will ask for like medical expense that you pay along with all of the charity deduction. Charity, like when you pay to, you give it to temple or church, donation to goodwill, all of those stuff. We add all of that up for you.
Gotcha.
If you're taking itemized deduction.
Yeah, so that's a really benefit of having a CPA looking at all of the documentation for you during the tax season, correct? Otherwise you just use the default standard deduction that TurboTax or software provided to you without knowing that maybe itemized deduction is better for you.
Yes, if you know, if you're using software like TurboTax or whatever tax is out there.
HR block.
Yeah, HR block. They will lead you. They will ask you if you pay any interest for your home. They will also ask you if you pay any property tax. I believe they will lead you through also.
Oh, okay. That's good to know. That's good. All right. Okay, so we have another question from the audience. How about investor? Right. So we're talking about people that owning a home as a primary home. Is there any additional tax deductions for an investor who buying a house to rent it out?
For investor, first of all, you don't have to face the state tax and local tax limit that I mentioned earlier. What is the 10,000 tax for investor? You don't have to face that cap limit, which means all the property tax you pay, you will be able to deduct. Okay.
Wow.
All the rental tax you pay for your rental, you will be deduct. And also advertising, mileage you use to go and collect your rent, your cleaning, your commission, the insurance you pay for the house, any legal expense you pay, management fee, the interest you pay for your mortgage if there's any repair cost, and utility if you pay them, and homeowner association along with depreciation. So depreciation is one of the items usually taxpayer don't know. Usually you need an accountant to figure that out for you.
Gotcha. So it's require an accountant, but can you provide like general idea of what that is? High level? Is it simple to explain? I'm not sure.
The depreciation?
Yeah.
Depreciation is just it's to be in detail. It's kind of how do you explain? They allow us to deduct the cost of the building. For example, if your house is 500,000 and the land cost is 200,000, the building cost allocation is 300,000. They will divide that 300,000 to 27.5 year, and every year we'll be able to take that as a deduction.
Okay, I see. So obviously, as an investor, you have more deduction you can claim than the one who used the home as a primary home, correct? I'm talking about you can claim HOA, you can claim utilities, you can claim all the maintenance, all of these that I just mentioned, you cannot claim as a tax deduction if you own the home as a primary home, right?
That is correct, yes.
Yeah, there's so much more benefit for investor that way. Okay, so there is also another question about how do we maximize those? Since we are having a lot of deductions, so is there a way that we can maximize tax deductions and for the investors?
So as long as they paid it out, just make sure they keep the receipt and have a log that they paid out, and we just maximum the deduction. Usually we will try to ask them for
Okay.
Have the expense to maximize their deduction. So if they pay, we will max it out.
Gotcha. Now, this is just a question coming to my mind is that is it a good idea to create an LLC for a rental apartment for tax purposes?
Well, LLC is the name stand for. It's a limit liability company. Okay, so it is limit liability, and it protect you from any lawsuit or anything the property can bring on to you. However, there's also some rule and regulation you have to follow if you put the property under the LLC. So pro and con. But yes, if they can open an LLC, then yes, put the property under the LLC.
Okay, gotcha. Thank you. All right, there's another question here. A lot of people selling the house in 2020, and this question come up multiple times too. Do I have to pay tax when I sell my home, given that you could benefit like hundreds of thousands of dollars when you sell the home, right? So do they have to pay the tax?
It depends.
Okay.
If they own the home and leave the home, I would say the exact phrase they use is they have to be primary resident at least 2 years in the last 5 years, which means 5 years before you sell the house, you have to be the owner of the home and live in that home for at least 2 years. Okay. So if you qualify for that condition, you will be able to exclude the gain that you have from selling the home. And every single person, you can have 250,000 exclusion.
Wow.
And that's called Section 121 exclusion. If a couple, they can have 500,000 exclusion. So a lot of people, if they have gain within that limit, they don't have to pay tax if they sell the home.
Yeah.
However, there are limits, which mean you can only do that once every 2 years. Okay, and if you use the home for other purpose before that, then that will be calculate using percentage. Like I experienced that some people they live in that house then for a long time, and then they move out, they rent it out, but they want to take the exclusion. They want to move back in to take the exclusion. Okay.
Oh, I see.
As long as you move back in, you live in that house for 2 years within the last 5 years, yes, you qualify for the exclusion, but they will use the percentage of the time that you are primary resident comparing to the percentage of the time that you rent it out, and they calculate the exclusion accordingly.
Oh, I see. So obviously there's a lot of calculation there. So
yes,
you need an expert for figuring it out.
Yeah, but if you only use that house as primary resident, then you have the exclusion.
Gotcha. So that's a key point, right? If you use that home as a primary home for the last 2 years,
for 2 years in the last 5 years.
Gotcha. For 2 years in the last 5 years, you don't have to pay the capital gain tax if you sell it.
That is correct.
Okay, gotcha. Right. So for investor, my advice is to seek out to a CPA or to you for more detailed calculation to accurately calculate the tax.
Yes.
Okay. Okay. Yeah. I think those are very good information, Renette. Thank you so much again for being with us today. I know that we don't have a lot of time, so those are really useful information. If you do, however, have more questions for Renette, feel free to contact her in the number in the section below, and she's more than happy to take your call, right?
All right. Thank you. Thank you,
Yeah.
Long.
Thank you, everyone, and I hope to see you in next video.
Yeah,
Bye-bye.
thank you, Long. Have a good one. Thank you for having me here. Bye bye.
Bye-bye.